Why is Quant picking up so much in India?
You're looking at data to make even subjective decisions. We at Qode are coming from a very research standpoint that the decision to buy and sell a security is from a quant perspective.
We don't particularly try and look at short-term trends and then make a model out of that. Dhoni's win rate and he's won 5 IPL Cups. Same Rohit Sharma has 5 IPL Cups. Compare that to a Kohli, he's only won 1. It's that small percentage that ends up building that edge over a long period of time.
I'm reminded of a quote, Sir John Templeton. He said that I don't think there's any security analyst alive today who's had more than 2 out of 3 picks that worked out.
You can have a 10 bagger in your portfolio, but if you allocate it too little, it's not going to matter.
From a quant model, there are 2 things that would attract money. One thing is growing earnings. Second thing is being available for cheap.
Hey everyone, welcome to Leverage by Qode. I am Prateek and I have with me the founders of Qode, Gaurav and Rishabh, for this conversation. And we'll be talking about how the institutions, the smart money go about investing and how Quant deals with it. So welcome to this conversation and let's get started.
Thanks, Pradeep.
Thanks a lot, Pradeep.
To begin with, why is Quant picking up so much in India lately? Especially since we started back in 2018, it's picked up a lot of steam. What do you think is the reason behind this kind of a big shift?
Quant, I would say, is a very broad term, specifically within the markets that we look at. It could be used on the equity side. It can also be used on derivative side. On the derivative side, a lot of people have algorithmic models. They know the trades are very frequent. They want to be closer to the location, and more than 50-60% of the trades that are happening are through, systems. So over there, quant has grown a lot, but we want to largely focus on the equity side. The focus where trading is happening through systems, that probably is less than 1%. So that side has not been explored much. There are some things that have been tested in different markets and, that being tested in India also that have done well. But, I would still not say that it's reached a big size for now.
I think to add, maybe like the way the world looks at quant and the data that we have out there is more from an execution standpoint and less from the research standpoint. Where we at Qode are coming from is from a very research standpoint that the decision to buy and sell a security is from a quant perspective, right? So the data that we are seeing out there, like for example, 50 or 60% of the trades that are going through are pretty much driven by systems. I think that's more from the execution standpoint, which is fine.
But that's not the real edge, because if everyone start doing that, there's no differentiator.
Absolutely, right? So to take a decision whether I should be buying this stock or selling this stock or whether I should be holding on or not, I think that ratio or that percentage might be at low. I don't know if there is a real number out there, but we, at least within the circle, we know that very few people are yet doing that. As data gets, more easily available, freely available also, I think that number will keep going up because people understand the value of, what data can do for you in terms of reducing time to research, etc. So I think, that what Gaurav mentioned, the differentiation between algorithmic trading and quant sort of needs to be made. And, from the algorithmic trading side, it's pretty much price and volume and volatility driven, or maybe liquidity driven. And I think on the quant side, what we are trying to focus on is largely from a fundamental business standpoint, how do you take decisions to buy a stock or not?
Would you say like the rise of passive funds in India, right, which is primarily, there's no active manager out there. Would you consider that under the quant?
When I speak to someone, the conversation is always to start with, to imagine of quant, think of Nifty, right? Nifty is probably the most simple or the most basic quant model. For us, quant is a set of rules, and Nifty is basically taking a very simple rule that, I want to hold the top 50 businesses based on free float market cap. And that's a model. The reason why, I don't know if I would want to term it quant or not, but yeah, it's a passive fund wherein, those 50 businesses keep churning, once in 6 months based on the free float market cap. So I think that is sort of the passive side. That because of, in the West, I think 60-70% of the investments that households are making are in passive funds, especially the S&P 500 Vanguard fund. And, because of that education, it's being also translated down to India. Lot more small cases coming up, lot more ETFs, that are being launched, the value ETF, momentum ETF, etc. And people are getting to that exposure. I think that number is just going to go up from here on.
You're absolutely right. Today, passive funds are roughly about 16-17% of the total AUM. That compared to 5 years back, that number was close to 10-11%. So there has been an increase in the passive funds. Earlier, the passive funds or ETFs as well, there were limited options in terms of what you could actually do, a Nifty or few top indices. But now a lot of volume in the momentum, volatility, value. Most of these, there are sectoral ETFs that are thematic ETFs that are coming in. So what is happening is people are understanding that rather than them taking a bet on an active fund manager that could or could not perform well over a period of time, they just want to be invested in the India story. For them, this becomes a very good product.
So now that we have a better understanding of how we look at quant, right? Could you just answer the most common question that we keep getting, like, is quant a black box? Like, people still misunderstand it.
We've answered this question many times, and quant, when we are thinking of quant, I think what we are thinking of as a set of rules framed around data so that it can help us make a decision. So it's not a random back test. It's not like a random code that is written and is going to throw out a stock. The idea is that those rules sort of are made in a way that it emulates our thought process around stock picking. It's not a black box in any way. It's a very simple version. Actually, it's quant is a sort of a technical word, but ideally it's a set of rules that you would frame around, say 5,000 businesses, narrow that down to maybe 230, add a few more rules, get that down to a 20-30 stock portfolio, and then churn that portfolio on and off. Another version of quant is also wherein you're using data, like stuff that Ray Dalio does on the macroeconomic side, wherein you're looking at data to make even subjective decisions, right? Whether sometimes you can't always run a back test on every data point, but what you're trying to do is make sense of multiple data points, use it subjectively until you can actually make it a system. The idea of that mindset is that, okay, fine, I'm not going to try to use intuition in any way. I'm going to rely solely on data, maybe 15, 20, 30 years, maybe India, US, China, whatever I can get my hands on, and then try to make sense of it. So yeah, it's not a black box. I think it's completely logical, if not a perfect science, but it's trying to be as scientific.
Absolutely. So Rishabh, I think explained it well that Nifty is a quant index as well. So for example, Nifty has a certain set of rules that some stocks get added into the Nifty, some get removed. The ones that get added are the winners over the past, and the ones that get removed are the losers over the past. So there's a certain set of rules that keep happening within the Nifty. Now I would describe a quant model as, let's assume that I take all the small cap companies and then I want to just pick the quality businesses from that. So let's assume I pick a metric. Let's assume that metric is a return on capital employed. If I just pick the top 10% of these companies and run that model, let's say for the last 20 years, 25 years, I would have seen that this model gives me better return than those stocks or the index itself. So this is a quant model. Over here, we're not trying to analyze a business. Over here, we're not trying to take a subjective call on a business like a fund manager would do. And I mean, if you look at a fund manager as well, the average, the chances of them getting stock right is 55 to 60%. It's not like they're getting 80-90% right. So this helps you with that framework, helps you understand how can your portfolio do better over time, make the process repeatable. It's possible that a fund manager can pick a particular company that grows 5 to 10x in value over the next 2 to 3 years, but is that process repeatable? That's the question that Quant helps you answer. It helps you structure portfolios for a longer period, 5 to 10 years, rather than hoping for a 1-year outperformance.
I'm reminded of a quote of Sir John Templeton, where he said that I don't think there's any security analyst alive today who's had more than 2 out of 3 picks that worked out. So in terms of like win rate, I think we're thinking about probabilities, and quant just helps us, like, not saying that it'll work all the time, but it just helps with the process of getting better.
Yeah, I think what Gaurav said in terms of like a repeatable pattern, right? What you want to find is a repeatable pattern. You're not looking at, okay, whether one stock became a 10, 20, 30 bagger. You're looking at like, you want to fish in the right areas. And then if you have a 60-70% win rate, that could give you a very handsome result.
So how does quant help us consistently outperform compared to, let's say, emotion-driven investing?
The question to be answered over here is, let's say there's an investor. Would that investor be wanting a 40% return in 1 year, or would that person want 25% return over 3 years? What is it that someone's looking for? Most of the retail guys just aim for the next one bumper year. That's what they're looking at. They don't look at the portfolio in terms of 10 years. For example, if I was to tell you that 25% return over 10 years makes your portfolio 10x, is that something that you would want over 10x? Most people would say yes. But in terms of taking action, they're just chasing for the next best fund that's available today. I was in fact recently having a conversation with one of our investors. They invested in a more aggressive strategy versus a safer strategy. The aggressive strategy didn't do well over last 1 year versus the safer one, which did. And then now they're looking to move their portfolio to a safe one versus move out from the aggressive one. Now, if you ask me, is that the best thing to do for the next 4 to 5 years? I would say no. One thing is, what is your investment horizon? What sort of returns do you want over a 4 or 5 year period? If you want to take that call over a 1 year period, just becomes, coin toss. It's not going to get you there. But if you look at that process over a 4 to 5 period, that's what helps you stay consistent.
So we know that no strategy or system is perfect. Neither is Quant, right? So where does it actually fail, and how do we build like guardrails around it?
I think, there are multiple places where we falter in terms of quant models. Starting with, first I can give you just a macro overview. First thing is from a position sizing standpoint, like how much can we have a large position? It becomes really hard when you're only relying on a quant model. The second is from a regime change perspective. Different regimes we've seen, like, different stocks or sectors performing. For example, 2017, 14 to 17, we saw a crazy small, mid cap rally. 18 to 20, we saw that the small caps did really badly, and that's when the large caps and the value businesses end up doing really well. Again, like 2020 was a bad year because of COVID, so that was a surprise element. That's also one of the factors which is a problem on the quant model side, because this data is really fast changing, right? Like, no one could predict something like COVID coming in, or markets being falling 30-40%. So sometimes quant ends up failing out there too. Other than that, I think the big challenge that we have is overfitting. From a quant model perspective, that we run a backtest, and the backtest is only good for that data set, right? Like, say for example, especially, and that ends up happening when the data set is really small. If you're only looking at 3 to 5 years of data, and then you see that, okay, fine, like for example, if you run a long only backtest from 2020 to 2024, you would have seen absolutely everything is done exceptionally well, and that's where we saw momentum doing extremely well, and then post 2024 everyone started underperforming. So these 3-4 places, I think quant ends up faltering. To tackle all these problems, you have to be able to think in first principles, strip down to the basics. So when you're looking at a backtest, try to figure out what kind of businesses are coming in, how have they performed. Don't just rely on the CAGR number and get happy by looking at that, right? Figure out which year, how much money you made, which stocks ended up contributing to the portfolio, and is this a repeatable pattern? Or I think Sanjay Bakshi also talks about this, of thinking in terms of probabilities, right? Wherein every new milestone that the company achieves, you can keep scaling in, and then everything that is not working for you, you can keep scaling out also. In terms of the regime change problem, I think that's a matter of studying as a human, and I don't think so the model alone will be able to define that regime. You'll have to actually understand that what has worked when, and how does it perform in different times, how macroeconomic factors are affecting. As we speak, for example, we are in an extremely volatile environment, and there are geopolitical factors that are actually driving markets.
Absolutely. I think, I can add a little bit to what Rishabh was saying. So let's say in terms of a regime change, what we do is we have some quant models that give us direction in terms of how could the next year look out. So let me give you an example. There's an index on a scale of, let's say, 0 to 100. We track how attractive or, how less attractive the markets are. Let's say if the markets are at 70, that means, the markets are, fairly highly valued, and if the number is closer to 30, then that means it's a good time to be investing in that particular market. Now let's assume, let's say last year example, we were tracking the market last year, that number was close to 80. Now if you look at, let's say, the mid cap index over the last year has given single digit return, though from that point the P multiple at that point in time was 42, 45, around that range, but now it has come down to 30. So what has happened is you have still not made return on that, but you've not lost money. So even if the markets tell you that you're the number that you're tracking, currently it's at 80, that doesn't mean you can go short on that. It's possible that you can remove your allocation slightly from it and reallocate to something that is in the range of, let's say, 40, 50, but still possible, from that 80, it can go to 90. So it's a game of probability. You're never going to get a score of 100 or 0. And the longer you play that game, the chances are that, over a 5-year, 10-year period, the odds will play out in your
Favor.
One rough example that I can give you, a cricket analogy that I was just thinking of. If you look at, let's say, Dhoni's win rate as a captain, it's about 57, 58 odd percent, and he's won 5 IPL cups. Same if you look at, Rohit Sharma, his game win rate is similar to Dhoni's, and he's won 5 IPL cups. Compare that to a Kohli, that is about, closer to a 50%, and he's only won 1. So, it's that small percentage that ends up building that edge over a long period of time.
It's even, it's very similar to the video that Roger Federer, where he speaks about like his win rate, where he's won only 52% of the points across his career, or 53%, the number which is very surprising, right? But the idea is that like in this entire game, whether you're playing sport or finance, right, is the small things that matter, and you have to win when it actually matters, right? Like even if from a position sizing standpoint, you can have a 10 bagger in your portfolio, but if you allocate it too little, it's not going to matter. But if you have a proper allocation, then that sort of is going to change the entire game for you. And I think what we end up doing is that try to figure out what's the most optimal number out there, and this is where Quant ends up helping. You're never going to be perfect, right? This game never makes anyone perfect. Even Warren Buffett has seen his portfolio fall by 50% 4 or 5 times in his career.
So, how much does a role of, let's say, liquidity or studying smart money or institutions factor into your quant models, right?
Let's say that over the last 6 months or so, couple of stocks got added to Nifty, and then couple of stocks got removed from that Nifty. Now, just from that move, there are a lot of index funds that are tracking it, which now automatically have to buy those stocks that are now a part of 50. As a result, what happens is there's a flow of roughly, $500 million, close to $1 billion in some of these cases, that flow in directly into these stocks. So as a result, these stocks go up. So now, firstly, they got became a part of Nifty because they had moved up to a certain extent, and now they got more liquidity. Now it has moved up.
We saw this with the MSCI index when HDFC Bank was entering the index, right?
Yes.
When it was just going to qualify. And I think people already preempted this, that okay fine, it's going to be a part of the index, and once it's the part of the index, they started calculating, okay fine, what's the kind of inflow the stock is going to see, and the stock already started rallying before it became a part of the index.
So there is a large portion of liquidity that matters if it just let's say get featured in the index. Now there's liquidity from, I would say, a country level as well, from an emerging market level as well, from different flows that keep happening.
But don't you think so, these things matter only in the short term, right? It's not a long term phenomenon. So HDFC Bank could very well be up like 5%, 7% or 8% for that month, but ultimately if earnings don't catch up, it's going to move back to where it needs to be.
Absolutely. I would say in the long term, from a quant model, there are two things that would move, that would attract money. One thing is growing earnings. Second thing is being available for cheap. If there's, I would say historically gets moved into these two things. Now look at the opposite side of it. Let's say that there's a particular company that the earnings are not growing and is expensive. Now, most likely, like I would say, again, there can't be a 100% situation, but most likely money is going to be moving out of that company, if not within 1 year, then over a 4 to 5 year period. So what we as quant managers try and do is understand what is causing the earnings to grow, what is causing, the money to flow to, let's say, cheaper companies, and how consistent is that. Over a 5 year period, let's say if you just catch that trend effectively, you would have made a much better return than what the index or the other companies would have.
You mentioned that, let's say, look at it at a macro level. India could be a growth market, so India is like a growth stock, and China was a value, right? So we saw that the FIs saw that there was a kind of a degrowth, or there was slowing down of growth on the India, so they moved money from India to, let's say, a value opportunity in China. So this can also play out on a macro to a stock level. So it's basically how like money is moving? Are you saying like, this is how money is moving from one asset to the other, one country to the other? It's basically either growth or value that dominates the flows.
I think the important point over here is the flows do matter. However, it's possible that they matter only in the short term. From a long term flow perspective, you have to get one of the two things right. Whether your earnings need to keep growing, or you have to be significantly cheaper, undervalued.
Like I think like it's more like the cigar butt investing and like versus that's what Buffett would do earlier, and then he moved once and he shifted once Munger came on board. He shifted to okay fine, let's we want
To buy
like a or maybe an expensive or a moderately expensive business but with great fundamentals, right? Like you're not looking at just price out there. What he learned from the intelligent investor was that okay fine, if something is available at much below its intrinsic value, then you should be picking it up. But I think now they've moved on to okay fine, if the business is good looking, only then we are sort of interested. So I think what the liquidity part, it will only matter in the short term. So if there are guys who run quant models on say like a quarter basis or a couple of months basis, and I think out there it would definitely make a difference. But if you're looking at any time horizon which is north of a year, the effect will be a lot lesser.
And it's possible that there are fund managers that only focus on short term swings but do it consistently. It's possible that they're tracking one flow from, let's say, Nifty as an index, but they're also tracking the similar flow in an index in China or, US, and they consistently keep doing that. And that could be a model. We don't particularly try and look at short-term trends and then make a model out of that. We are largely looking at long-term trends.
Right. So look, talking about long-term trend, there was a long-term trend in Indian markets where FIIs were, having a significant ownership of the Indian market, and with the recent sell-off and the SIP flows, like right now it's more than 25,000 crores. The trend has reversed. So look, talking about, do you see that as a long-term trend?
No, I think that's an important point. Till about 15 years back, DIIs used to be almost half of the FII investments within India, and then any move from the FIS would significantly change the market. If you look at, let's say, 2008, how much money FIS removed, and the market fell almost 50-60% because of that reason.
When you really think about it, like on the Nifty 50 you end up seeing it. I think there could be two phenomenons over here. It's hard to give like a black and white answer in this, but there could be two things that's going on over here. The Nifty has become really large, and the businesses that were like now that comprise, for example, the Reliance and HDFC Bank, TCS, etc., are really large. Very hard to move these businesses now with even the FIIs moving out. So the domestic money sort of could have that effect on at least the mutual funds, and the domestic institutions are right. Like we have seen days where the US markets have opened down 4%, 5%, and India is down like 1.5%. So the shock is being absorbed. A lot more savings coming in. We are not seeing deep drawdowns in the fashion that the US is seeing. But the moment you move to smaller businesses, I think we do yet see those large shocks, like especially the post the BSE 500, the businesses that come after the top 500. I think out there the 500 to the 501 to 1000. I think out there deep drawdowns are a regular phenomenon. Once in 3 years we see like a 35% or drawdown. If you see a year like 2020, you could be down 60% also. So I think so. Wherever the institutional holding is large, at least towards the larger businesses, I think the shock has been absorbed. Absolutely. But on the small cap, micro cap side, I think we are yet seeing a lot of volatility.
Yeah. In fact, there's also some reshuffling that we see within, large caps and mid caps. So an important stat is, let's say any company on an average less than 5,000 crores, you'll see that there are, a couple of thousand, maybe 3,000-4,000 companies that are less than 5,000 crores out of the, 5,000 companies that are there. About 0.1% is the total ownership, including FIIs and DIIs. So it's not that FIIs and DIIs hold a large portion in these smaller companies. But in terms of rotation, what we see is as soon as FIIs remove money from the larger companies, DII keep buying those shares, but it's possible that they're selling the smaller companies that they could be holding.
You see, like as we're speaking right now, December of 2025, right? The Nifty is barely down maybe a couple of percentage points from its peak, and we've seen the small cap and the micro cap index take a very big beating, like at least 15-18%.
Especially if you look at market breadth, I think below 10,000 crore market cap. 1 in 4 companies are seeing more than a 50%.
I feel like also what's happened is that the small cap index itself, right? Like we end up seeing that a lot of the PMSs, especially the ones managing say sub 1,000, 2,000 crores, when you're holding smaller businesses and then your benchmark is say the BSE 500, I think there's a big disconnect because the Nifty small cap index, the Nifty small cap 100, the smallest business is about a 18, 20,000 crore business, right? Which in my opinion does not qualify as a small cap. Right, it definitely qualifies maybe as a mid cap, if not a large cap, right?
The portfolio is not representative of the benchmark.
Yeah,
Hence
like the
comparing.
benchmark is no more like, most of the benchmarks that we are seeing are pretty much the large caps and, a little bit of the mid cap. So I think that also from from an investor angle, you got to be able to segregate these things, right? In fact, recently also Capital Mind had put up a post about, how 2019 the businesses that were qualifying as small caps are now actually become large caps. Yeah.
All right, let's go to the next segment. It's called Scroll Check, where we're gonna just pull out some posts from the internet, the chatter on the internet, and we'd like to take your views on what people are saying, the tweets, right? This is not something you have seen, so this is the first time I'm gonna be reading out.
Sure, let's do
Right.
it.
So the first one is Fed keeping rates at 5.25% forever. No cuts coming. Dollar staying strong. This means FIs will never come back to India. We are cooked. Move to gold.
I think, maybe don't have a black and white answer again, but the gray answer would be that this kind of data definitely does affect the markets and affects the market in a very heavy manner. Fed, whatever the decisions they are making sort of will have an impact over here. From the volatility perspective, I think I've been like screaming about this that I think there's something going to happen in the US, and you should be wary of investing in the US today, especially for the next 2-3 years. I don't know about moving to gold completely, even though a large part of our portfolio with all weather is gold. But now, as we speak, like markets are getting a lot cheaper than what they were. I think in the next couple of months, you might just see some opportunity to move to the small and mid cap space. So I don't think running away is an option. I think, we were speaking earlier, right? Like Gaurav, you can emphasize a little bit on the earnings growth that we've been seeing.
No, so in fact, just looking at the earnings growth, like I mentioned last time, there have been stocks that we had identified, or I would say a group of stocks that we identified a year back, and the P multiple was extremely high. We've seen a tremendous earnings growth, but we have not seen that same, growth on the stock price, mainly because the P multiples have contracted. Now, if you ask me, it's a much better time, to be investing here. So coming back to, your quote where, your tweet where someone saying that, FIs are never coming back. I think there's a 0% chance, if you ask me, over the next 5 to 10 years, of significant inflow, because see, liquidity keeps moving. Right now it's possible that, let's say, the yields over there are high, and the investors want to take advantage of that, but that's not going to stay forever. They are going to chase growth at some point in time.
Let the tables turn, right? Like what's happened is that the S&P 500 and Nasdaq have shown some like crazy returns over the last 1 year, right? And what we were speaking earlier, they're going to chase returns. So if for example, like the S&P 500 is doing like, or the Nasdaq gave like a 30-40% return, and here the rupee is depreciating against the dollar, obviously that will look more lucrative. I think just wait for the next 1.5-2 years, you'll see a shift in momentum the moment India starts doing well, and you will see that like maybe that the AI bubble actually sort of collapses, or there is change in valuations out there. Money will flow really fast, and it changes overnight. In a matter of week, you will see that the mood and the sentiment has changed completely.
In fact, if you look at the last 15-20 years of data, there's a particular range that the S&P trades in, and particular range that the Nifty trades in. Today, it's at a 25% discount to where S&P is, which has not happened.
If you look at the Nifty to gold ratio and the S&P to gold ratio also, to add on what Gaurav is saying, like the S&P to gold ratio is at an all-time high because the S&P is done really well, and the Nifty to gold is like at a 0.6, 0.7, which is towards the bottom end of the spectrum. So I think it's looking like, India is a lot cheaper than the US. And, I think it's just a wait and watch game.
Talking about like the Fed rate cut, I mean, if the rate cut does not happen, there's a very high chance the Fed chairman might change. I mean, Trump himself has hinted a lot in these recent times. Another tweet we have is on the FII selling, right? So FII sold 1 lakh crore in October, now another 20,000 crore in November, but market is only down 6% from top. How is this possible? Are DIs just catching a falling knife?
I would say, see, FI selling in terms of quantum, we try and compare it to the earlier times and then we end up saying that, hey, it's a lot. But if you see, over the last 15, 20 years, the index itself has grown quite a bit. So the impact that 30, 40,000 crores used to have in 2007, 8, that's impact is obviously not going to happen.
But it catches these headlines by
It catches these headlines. Everyone's talking about, hey, highest ever sold, and there are going to be a lot of highest ever things happening as the index.
I think you can't look at everything only in rupee terms, right? Like you have to look at it in percentage terms, and that's when the number.
Yeah.
But in context, right? I think what the tweet is coming from is that okay, fine, like even after the FIs selling, we've not seen a lot of movement. I think so. We have seen movement. It's just that doesn't reflect in the index.
Yeah.
What happens is that the Nifty is it's pretty large and does not actually represent the entire market as a whole.
Just to give you context, so when FIs have sold worth 1 lakh crore, the holdings that they still have in the market is close to 75 lakh crore, so they've sold 1.5% of their holdings.
And the numbers are very news catching, right? Like I think it's nice to to have a headline news that says FI has sold 1 lakh crore.
I mean, Indian markets now are like around $5 trillion market cap. So, scale also is a factor that needs to be looked at. Okay, we have one on Pine Labs. IPO opened November 7, subscribed only 0.13x on day one. That's catastrophic. 3,900 crore IPO, nobody wants it. Meanwhile, Grow IPO got 17.6 times oversubscribed. Same week, opposite results. Is the IPO market dead or just selective?
I think it's pretty selective. If you look at the IPO market, in terms of numbers, it's not that big, right? When you're looking at like 13,000, 14,000 crores, I think that's what Grow did in terms of, money that needs to be raised. And Pine Labs was about, you mentioned, 3,900 crore IPO. So I think the number is really small in the context of the market. In the IPO market, I think a lot matters as to what the merchant banker is doing, what the company is doing in terms of going out there, in terms of the roadshow, and how they end up marketing rather than the valuation itself. So on the Grow front, right, like people love the promoter, people love the four of them. I think there's a very hero image out there, so very easy to subscribe to something like that. Like you mentioned, it's very selective. Also the sentiment in the market does matter.
One thing that I would say we try to look at, if you're looking at analyzing that particular company as an investment, try to generally stay away from IPOs. Maybe see 2-3 results after it's listed and see what the trend is like. What ends up happening is possible that we end up missing out on a good opportunity. But what we've seen is in the pursuit of raising money, it's possible that they end up listing it right at the right time and the sales are the highest, the profit is the highest, and then when they raise that kind of money, they don't continue to see that traction. So we try and wait for a couple of quarters to actually judge that. But having said that, talking about your point, I would say whenever a company is raising money, there's different allocations, some towards larger corporate, some towards UHNIs, and then some towards retail. I would say a large 70-80% of it is already subscribed in most cases. It's only few things pending for the money to be raised. So I would say the failure for an IPO, in my opinion, is unlikely unless the shares have not been pre-sold or pre-committed by investors.
Now we'd be moving on to the next segment. It's called Answering the Internet. We've pulled out some questions from whatever questions we've received in our DMs, and I'll be asking you those. So the first question is, Nifty is near all-time highs, but the small cap index has been weak. What's driving this divergence, and how should investors think about small cap selection when liquidity dynamics are so different?
Over the last year, we had earlier seen that the small cap valuation, especially mid cap valuation, were extremely high. The reason for that is obviously there's growth expected from these companies, from these segments. When I say growth, it's largely the earnings growth that has, that needs to be coming from these segments. To answer the question, has there been earnings growth? The answer to that is yes. Has it reflected in the stock price? The answer to that is no, because multiples have contracted since that point in time. But at what point do you continue, to reward in terms of the share price, in terms of the earnings growth? I think it depends on the quantum of the earnings growth that keeps happening. If you ask me, from a 4-5 year period, does it look like an attractive segment to us? Absolutely yes.
We also saw the same phenomenon back in 2018, and it was pretty gruesome back then. 18, 19, 20 value stocks, the large caps ended up doing really well, and small caps were down almost 45-50%. We see this phenomenon on and off. From a quant angle, we are not really surprised because we know that this has happened in the past.
Right, but 2018 one, like when we looked at earnings, the earnings were not supporting the rally of 2014 to 17, whereas as like Gaurav rightly mentioned, the earnings have been pretty good. It's the valuation that the excesses which are getting corrected.
That's absolutely correct, right? Like, the valuations whole of last year, whole of 2024 has been obnoxious, and that's why on our end, allocation was not towards the small and mid cap side. Allocation was towards the large cap and the gold multi-asset allocation, right? So that's the role of a fund manager. At the end, like, you have to take a timing decision. Whoever you are, you have to decide whether does it make sense to allocate, because price does matter. If you want to look at, high double-digit returns, entry price will matter a lot.
So the next question is, every cycle has its darlings and orphans. Defense, railways, capital goods have a massive run. FMCG and pharma have lagged. From a quant perspective, how do you identify when crowded becomes dangerous and when ignored becomes opportunity?
Again, like say that the way we look at it is in terms of a final score between 0 to 100. Again, there's going to be no 100, there's going to be no 0 in any of these situations. Now, if you were to rank, sort of different sectors and judge each of them individually, you'll see that some of them could have been overvalued, some of them could have been undervalued. Now, let's just pick defense, for example. Within 3 months, the defense index had run up close to 60-70%. There were 4 more funds that got launched. They had to deploy their money within these companies. And because of that, see, it's, the thing that goes up keeps going up, for a reason. At some point, it stops being attractive to investors, even, looking at the long-term growth. And at some point, it's possible that there might not be enough long-term growth, but the value is such that, it looks attractive right now. For example, if you look at IT right now, it's, ignored. If you look at, banks, in select pockets, it's been ignored right now. If you look at, the potential growth or for it to become a darling, like I'm not saying that that is going to happen in the future, but it's still positioned well to, capture more market going forward. And I don't think the valuations reflect that. So I think it's a balanced game that you have to play within what kind of earnings and what sort of price are you paying for that particular company.
Thank you for the wonderful conversation. If you guys found it insightful, consider subscribing. And if you want more such market updates directly to your inbox, you can consider subscribing to our newsletter. And stay tuned for our next episode where we are going to go more into detail about the psychology of investing and the mental side that no one talks about.